Our session today will look at what is known as the cost volume profit analysis. Others call it the break-even point analysis, the BEP. So the cost volume analysis is a managerial accounting tool mainly used to understand how costs and our sales volume affect our profit. So this technique helps businesses to make decisions about how much to produce and how much to sell, what price to charge, whether the business is making a profit or a loss, and how costs behave at different levels of activity. So CVP is very useful when you're dealing with planning, budgeting, decision making, and break-even analysis. So managerial economics is interdisciplinary. So you find this in managerial economics, you find this in cost accounting, you find this in management accounting, and also financial accounting. So this is important. So now, what are some of the key components of the CVP analysis? So we need to understand, um, firstly, the sales revenue. The sales represents the total income that we generate from the sales of our goods and services. So the formula for our sales is simply selling price times quantity. All right. So sales is equal to what? P times Q, if you like, the price times the quantity. So this is our sales revenue, right? Then the variable costs, what are the variable costs? These are simply the costs that change with output. These include raw materials, direct labor, packaging. So if production increases, the variable costs will also what? Increase. If production decreases, the variable costs will also decrease. So these are the variable costs. Okay. So sales revenue or total revenue, if you want to call it, is simply equal to what? Price times quantity. So we also have fixed costs. What are fixed costs? Fixed costs are costs that do not change with production in the short run. So they include rent, salaries, insurance. Even if production is zero, the fixed costs will still exist. So graphically, these will look like this. These are total fixed costs. Okay. And the variable costs will look something like this, a variable cost. Then collectively, we have our total cost, which looks like that. So total cost is a combination of what? Fixed cost plus variable cost. And what is a contribution? Contribution is simply the marginal income. Contribution is simply the difference between the sales and our variable cost. So it shows you how much is available to cover our costs, how much is available to generate a profit. So the contribution is also called the marginal income. Okay, so contribution is given by sales minus variable costs. And contribution per unit is simply given by selling price per unit minus variable cost per unit. Okay, this is the formula. So the importance of contribution is that it will help us to understand um, how much is needed to cover our fixed costs. It's also important to determine our profit. It is also helpful to calculating our break-even point. So the contribution ratio or the marginal income ratio helps us calculate our proportion of the contribution to the sales as a percentage. So contribution ratio is simply the contribution over our sales times 100. Remember, the contribution is given by what? Sales minus variable costs. So contribution is what? S minus VC. That contribution per unit is sales per unit minus variable cost per unit. So contribution ratio is simply our contribution over the sales times 100. So the meaning is that it shows the percentage of sales that contribute to covering the fixed costs and the profit. So if our contribution ratio is 40%. What does it mean? That for every $1 of sales, we have what? $0.4 that contributes to our fixed cost and our profit. So how does it relate in the concept of profit when you're talking about CVP? So profit is calculated by our contribution minus a fixed cost. And we know that our contribution is simply sales minus variable costs. So profit can also be sales minus variable cost minus fixed costs. So what happens in this relationship? So if the contribution is greater than our fixed costs, we have a profit. If our contribution is less than the fixed cost, we make a loss. But if the contribution is equal to our fixed cost, we break even. There's no profit, there's no loss. Now, what is break-even point? The break-even point is a level where our profit is equal to 0. So it means that our contribution is equal to our fixed cost. So our break-even in sales value is simply given by the fixed cost over the contribution ratio. And our break-even in units is given by the fixed costs over the contribution per unit. So this is in terms of units, and this is in terms of the sales value. So the importance of break-even point is that number one, it will help us show the minimum sales that we require to produce in a company to avoid making a loss. It is also helpful when we're making decisions as a firm as to what the optimal production point is. It is also very important in our planning, in our budgeting. We also have another important term which is called the margin of safety. Margin of safety tells us or shows us how much sales can drop before we make a loss. So if our sales are going down, so we need to know at what point we should stop selling before we go into what? Making losses. So it's given by the following. The sales of safety is actually equal to the actual sales minus the break-even sales. A margin of safety ratio, MOS ratio, is simply given by the actual sales minus the break-even sales over the actual sales. So the interpretation is that if you have a high margin of sales, meaning business is in safe hands. If you have a low margin of sales, low margin of safety ratio, it means that our business is in risky state, it's in red. Now, the relationships that we need to understand and CVP analysis is when the sales go up, our contribution will directly go up. If our contribution goes up, the profit will go up. If our fixed costs go up, our profit will go down because these costs are eating up. These ones have an inverse relationship. The other inverse relationship is on the variable cost. So the variable goes up, our contribution will do what? Will go down. So these are some of the assumptions that you need to have under CVP analysis. So CVP analysis is based on the following assumptions. Number one is that costs are classified as fixed costs and variable costs. So our total costs are a combination of only two, fixed costs plus what? Variable costs. What is the other assumption under which this CVP must lie? Is that the selling price will remain constant. Also that the variable cost per unit remains constant. Also that the production is equal to sales. We do not have any change in our inventory, and that there is a linear relationship. So the advantages that CVP has is that it's very simple and easy to use. It helps firms make decisions. It is useful when we are doing our planning. It also helps in what? Determining the break even. It has limitations as well. So in exams, you usually be asked to explain what are the advantages of CVP and what are the limitations of CVP. So you need to understand these ones before we go into calculations. So these formulas will be given to you quite all right, but I need you to appreciate the what? The concept behind. All right. So again, what are the advantages of CVP analysis? So advantages is that number one, CVP is very easy and straightforward. It does not require complex calculations when you are using basic relationships between the cost, the volume, and also the profit. It helps in decision making by showing you how these changes in cost, selling prices all affect our profit. So managers will use this to determine whether to increase or decrease their production, or whether to accept special orders in production, and also how to strategize on pricing. It is also useful for profit planning. CVP is essential when you want to plan for future profits. So it will help you to set certain targets by answering questions: how many units must be sold for me to get this desired profit? What levels of sales do I need to cover costs and to earn a certain return? And it's also helpful when you want to determine a break-even point. This is an important point in production because it is one of the key strengths that CVP has, where you have to identify the break-even points, i.e., that is a level of sales at which your total revenue is equal to total cost. Here you have no profit, you have no loss. At least it helps businesses to avoid losses and set minimum targets for their sales. The limitations, however, are that it assumes that costs are only fixed or variable, which is not true. It also assumes that variable costs will remain constant. It also assumes that selling price will remain constant. In reality, these relationships are not linear. For instance, if you are into bulk purchasing, you may reduce your variable costs and selling prices may fluctuate. This may be due to competition or market conditions. It also ignores the real world complexities because in the real world, some situations are ignored. There are changes in technology, there are market conditions, there are multiple product lines that are there. So CVP is less realistic. CVP also assumes that the fixed costs may change over time. Okay? It assumes that CVP costs remain constant within a relevant range, but in reality, fixed costs can change when you're expanding the salaries, you know. And the assumption that CVP is not actually always accurate in the long run. CVP is not suitable when you're dealing with short-term decision making. So these are the limitations that are there. And practical applications that it is used for decision making, cost control, planning, and expansion. Now let's look at this example here that will help us. So suppose we're given sales is 10,000, variable cost as 6,000, profit is 2,000, and margin of profit safety is 50%. Number one, find the contribution. So our contribution is given by our sales minus variable costs. So what are our sales in this case? Our sales, we have what? 10,000. The variable cost, we have 6,000. So 10,000 minus 6,000, that is 4,000. That is how we find our contribution. All right. What is our contribution ratio? It's so-called the marginal income ratio. Contribution ratio, we said it is what? Contribution over the sales. So contribution ratio is equal to contribution over sales. So 4,000 over the 10,000 times 100. So we get what? 40%. So this is what? The contribution over sales. So 40% times 100. Then we also are asked to calculate the fixed costs. How do we find the fixed costs? The fixed costs are given by contribution minus fixed costs. So now we want to calculate this fixed cost. So fixed cost therefore will be equal to what? Contribution minus profit. So we found our contribution as what? As 4,000. And the profit was given in this case as 2,000. So 4,000 minus 2,000 is equal to 2,000. So this is how we find our fixed cost. Okay. Then we're given a break-even margin of safety as what? 50%. So here we underscore that margin of safety is given by what? Actual sales minus break-even sales. Or actual sales minus break-even sales over actual sales. So this is the ratio. So 50% or 0.5 is equal to actual sales minus break-even sales over actual sales. So here what do we have? The ratio here is 0.5. Actual sales is what? 10,000. And the break-even sales is what we are calculating. So margin of safety is equal to what? Actual sales minus what? Break-even sales over actual sales. So here we have 0.5. So our break-even, the actual sales is 10,000. Break-even, we don't have actual sales 10,000. So cross multiply. This will be 5,000. We have 10,000. So this one will come this side and this one will subtract. So 10,000 minus 5,000. Our break-even sales are 10,000 units. Or you can use the other formula. What is the other formula for margin of safety or break-even? Yes. So you can use any of these ones here. Break-even in terms of sales is got fixed cost over contribution ratio. When we calculate our contribution ratio, in this case, our contribution ratio is 0.4. It's the same as the marginal income ratio. Okay, so break-even ratio is what? It's fixed cost over what? Contribution ratio. So our fixed costs are we calculated them as 2,000 here, and our break-even or contribution ratio is 0.4. When you divide this into the 2,000, we still get the same answer here as 5,000. So this is how we calculate that. So these are the figures we get here. All right. So let's try question number 1 here. We are given what? A company has sales of 20,000 and variable cost of 12,000. Can somebody help? How do you find the contribution? What is the contribution? Yes. Who wants to try? Contribution. What's the form of the contribution? Yes, Mr. Lupinga. You can try it, Lisa. What's the formula for contribution?
Sales minus variable cost.
Yes, sales minus variable cost. So what is our sales? 20,000.
20,000.
And variable cost? 12,000. What do we get? 8,000. Correct. What is our contribution ratio? What is our contribution ratio?
Would it be contribution over sales?
Correct. Contribution over
Multiplied by
sales.
100.
Yes. And what is our contribution? Contribution ratio is what? Contribution over sales
8,000.
times 100. What is our contribution? 8,000. What's our sales?
8,000.
20,000
40,000.
times
Multiplied
100.
by 100.
What do we get? 40%, right?
Hello, sir, I can't hear you.
40%. Can you hear me? Can you get me? The contribution ratio is simply the contribution over the sales. And our contribution, we just calculated, is 8,000. And our sales is 20,000 times 100. So when you divide that, we get what? Our 40%. Is that clear? Can you hear me? Am I audible?
Yeah, you are audible, though I had actually dropped. Is it the first question we are answering?
Yes, we've answered the first question. Now we're doing the second question. Just for your sake, the first question we're given sales um, um, is 20,000, variable cost is 12,000. So we are asked to get the contribution. Okay? So how to find the contribution is simply sales minus what? Variable cost. So 20,000 minus 12,000 is 8,000. What is the contribution ratio? Simply the contribution itself over the sales. The 8,000 over the 20,000 times 100 is 40%. Are we together? So let's go to question number two.
Yes.
Yeah.
Question number two, we are given what? The contribution is 8,000. The fixed cost is 5,000. How do you find the profit? What's the formula for the profit? Chileche, profit is got what?
Yes, really, I forgot. Is it
Contribution minus what? Fixed cost.
contribution? Yes, yes.
Fixed cost.
So what is our contribution? 8,000.
8,000.
What is our fixed cost? 5,000.
5,000.
So what do we get as our profit?
5,000.
3,000.
3,000.
So state whether
3,000.
we're making a profit or a loss. Are we making a profit or a loss?
We are profiting.
We're making a profit. How do we know it's a profit? When contribution is more than the fixed cost. That is when we're making a profit. When we're making a loss, contribution is less than the fixed cost. What happens when the contribution is equal to the fixed cost? What did I say?
Break even.
Break even, correct.
Break even.
Okay, let's go to this here. We're given the fixed cost as what? 6,000. And our contribution ratio is 30%. Let's calculate the break even of sales. What's the formula for break even of sales? Fixed costs over contribution ratio. Okay, fixed cost over contribution ratio. What is our fixed cost? 6,000. Contribution ratio is what? 30%. So what do we get?
20,000.
Hmm? What are we getting?
20,000, I think.
20,000. Okay, that's correct. 20,000. Right. Okay, now I want you to try this. A company has sales of this. Okay. Then we are being asked to do what? Find the margin of safety. How do you find the margin of safety? Who remembers? What's the formula for the
Sales
margin of
minus,
safety? Margin of
sales
safety is
minus,
what?
sales minus
Yes.
break even.
Yes. Sales minus break even of sales. Correct. Margin of sales is equal to what? Sales minus break even of what? Of sales. So this is what? 15,000 minus 9,000. What do we get? 6,000, right?
6,000.
What is the margin of safety ratio? Margin of safety ratio? We have the margin of safety over what?
Over, is it over sales?
Over sales, correct. So what is our margin of safety? 6,000 over what? What is our sales?
It's 15,000.
10,000. Okay, what do we get?
0.4.
Which is 40%, correct. Okay, 40%. Okay, let's try this one here. We're given the sales, variable cost, and fixed cost. How do we find the contribution? Contribution is what?
Variable cost, let's say sales. Sales, that's variable cost.
Sales minus variable cost.
We got what? Sales minus variable cost.
Sales minus
Variable cost.
So 25 minus what? 15. What do we get?
10,000.
10,000. And what is the
4,000.
profit?
Profit is sales minus variable cost minus fixed cost.
Fixed cost.
It's what? Sales. Profit is got what?
Sales minus total cost, one short minus variable cost and minus profit. I mean, fixed cost.
Contribution minus fixed cost.
Yeah.
Contribution minus fixed cost. You've forgotten. So what is our contribution? 10 minus
Contribution
fixed
is
cost
10,000.
is 5. So what do we get? 5.
5
What is the
sales.
break even? What is the break even? What's the break even of sales? Can use two methods. Break even of sales. How do you find the break even of sales? You start with the contribution ratio. What is the contribution ratio?
Sales.
It's 10. So
Hold on. Hmm? You've forgotten already.
Yeah, we need to revisit.
So where are we starting from? Firstly, we need to know that what? Contribution is equal to sales minus variable cost, right? We'll start from
Yes,
there.
that's clear.
Contribution, pardon? Is my screen clear?
Yes, we are clear on that one.
Contribution is equal to what? Sales minus what? Variable cost, right? So what was our contribution? We found 10. This, are we clear?
yes.
Yes, sir.
Then the break-even sales formula. What is our break-even sales? Break-even sales is fixed cost over contribution ratio. Okay? Break-even is fixed cost over what? Contribution. What is our fixed cost? 5. What is our contribution?
5.
10. So what
10.
do we get? 5,000. What is our contribution ratio? Sorry, 40%. Right? 40%. So what do we get? What do we get? Break-even sales becomes what? 12,500. So our fixed cost is what? 5,000 divided
5.
by this 12,500. Okay. So let's go to an exam paper now, which we will do as your homework. This is the easiest, one of the easiest questions that you should never leave behind because it always comes worse for you. It's one thing that requires less thinking. Once it's an issue of just knowing these formulas. and you get to remember. Okay, so I've talked about the formulas here. Let's look at this question here. Right, so here we've been given that question. What are we given there? What are we given there? Hmm? What are we given in this question? This will be your homework.
Yeah, so we have, okay.
So we have fixed
Yeah, it's
cost,
similar to what
70, variable cost, 90, contribution ratio, 75, and the budgeted sales units. So how do we find our um, contribution per unit? So contribution ratio, who remembers the contribution ratio? The contribution ratio is equal to what? Contribution per unit over selling price per unit. Contribution per unit over selling price per unit. So what is our contribution ratio? 75%. Okay, what else are we given? Our contribution, we don't know, but our selling price per unit we also don't know. Okay. So now, our question is asking us to calculate the contribution per unit. What's the formula for contribution per unit? The selling price minus what? Variable cost. Right? Per unit is equal to
yes,
contribution is equal to selling price minus variable cost. Okay, what do we have from there so far? We have what is our variable cost?
90,000.
90, yes. Okay, we have 90 as our variable cost. So what is our contribution? Our contribution is equal to selling price minus 90. Contribution is equal to selling price minus variable cost. So minus 90. You can leave it there if you want. Okay, so now we can substitute this. Well, there's contribution, we're going to put selling price minus 90. We'll go back to our initial. Here, contribution, we're going to put selling price minus 90. So 0.75, and you're going to have selling price minus what? 90 over selling price. So we want to make selling price subject. So just cross multiply. So 0.75 here times selling price is equal to selling price minus 90. So what do you do there? You make the selling price subject of the formula. So you're going to find your selling price as 360. Okay, so when you calculate this properly, there are two methods that you can use. You can make that subject formula, and you substitute in there. You find your selling price as 360. Okay, let me just go to pamphlet quickly. That we redeem time, we just have a few minutes. So having shown you that, page 16. So when you calculate this selling price minus 90, you first multiply. This is selling price B minus selling price minus 90. So in this one goes this side and this one goes this side, we have 90. Selling price minus 0. So here there's a 1 there. 1 minus 0.75 is 0.25. Divide both sides. 0.25 into 9 days, 360. So we know that contribution per unit is selling price minus variable cost. So our selling price is 360 and our variable cost is 90. So what we find as our contribution per unit is 270. Okay. This was one of the toughest questions under CVP. I'll need to do more questions on this.